Welcome, everyone, to our K-1 pass-through series. My name is Dave Stoffaker, the Senior Credit Trainer with Lenders Online Training, where we help credit professionals, credit analysts get to yes for good loans. I'm joined here today with our founder and Chief Credit Trainer, Linda Keith. Hi, Linda.
Hello.
Our series, we have a lot of questions. Here's the question for today. Linda, when evaluating the credit worthiness of a pass-through entity, what do we find on a Schedule E that kind of could help us understand the risk exposure to the owners?
Great question. And what we find on the back of E helps us with some of that and not with others. But let me just start out with this. The pass-through entities, 1065, 1120S, they definitely give us some clue as to the owner risk exposure, but it's a little murkier than that because different types of entities can file each of those returns. So I'm going to flip through those real quickly and tell you what's happening with owner risk exposure for each, and then we'll talk about what can we actually tell on the back of E. So let's start with the 1065s. 1065s can be filed by general partnerships, and general partners always have unlimited liability every time, no matter what. Do not pass go, do not collect $200. They are the riskiest entity we have for lending because anybody can make a mistake and any other owner can end up paying for it because they've guaranteed by definition. They haven't even guaranteed. They don't have to guarantee. They are unlimited liability. Now, the 1065 filed by a limited partnership. A limited partnership has limited partners. Those limited partners do enjoy limited liability. A limited partnership must have at least one general partner. The general partner has unlimited liability. And in a limited partnership, the limited partners can't be actively involved in the business. So they really are investors who don't have that liability for what's going on, except they could lose their investment, but they don't have to come to the table and cover debts and so forth of the partnership. All right. 1065 filed by an LLC, a limited liability company. Well, that one, the LLC does provide limited liability to the owners unless they've personally guaranteed. So you start to see it's not just the entity, it's not just the owner type, it is also did they guarantee or not. So limited liability unless they've guaranteed, in which case they could also have unlimited liability with regards to whatever they actually guaranteed. Then there's the 1065 filed by what in some states is called a PLLC, a professional limited liability company. In other states is called an LLP, limited liability partnership. These are entities that are licensed professionals. So CPA firm, an attorney's firm, an architect's firm, a medical doctor. Those of us with those types of licenses are not allowed to limit our liability for our professional actions by the entity choice we make. So as a CPA, if I issued financial statements that were negligent, I couldn't say, oh, you know what? I'm an LLC, so you really can't go after me. Yes, you can. Yes, you can. So with those, it's important to notice it and just make sure we have adequate errors and omissions insurance, professional liability insurance, medical malpractice. But for everything else, if somebody comes to my office, falls and breaks their leg and sues our office for that, now my entity choice can protect me. All right, so that's the 1065 choices, and there's a lot of them. Then there's the 1120S. This is primarily filed by corporations. Corporate shareholders have limited liability unless they have guaranteed or unless they are a medical professional, accountant, and so forth that don't have the unlimited for their professional activities. So that's the lineup of type of entity, type of owner, guaranteed or not. David, how much of that can we actually tell by looking at the Schedule E, and how much of it are we going to have to go somewhere else to find out?
Well, Linda, that's a lot of stuff there with regard to the different entities and
You taking notes?
So to answer your question, no, not much of anything. I mean, when you look at the Schedule E, we get the implication that, okay, there's a partnership involved. We don't necessarily know if it's a general partnership or a limited partnership. I mean, we'll see a P on the back of that, so it does imply that. Or it could also be a limited liability company. If they didn't put the LLC after that, I wouldn't necessarily know that. So that opens the door to a couple of things. Quite honestly, I won't know if it's necessarily an S corp with professionals. I won't necessarily know that tag as well, just by looking at how it is labeled there, if it's consistently. And I have seen a variety of tax returns over the years that don't have those labels to it. So that can be confusing itself, other than I know what tax return I may be looking for, but I won't know the great deal of details. The other thing that I would get to is the whole issue of guaranteed. You brought up the fact of guarantees, who may be liable. I would think it's basically on our guidelines as bankers, what we would either want as guarantee. Many bankers say, it is what it is. If it's a partnership, we're going to want guarantees of those parties involved, regardless of what they're doing to. It may be just a standard protocol. There may be some exceptions to that you might have, but it would be in your guidelines. I would think that if you are actively involved in the business, you are a high percentage owner, you are what we would say non-passive. We can tell that on the Schedule E, if they're passive or non-passive. If you're non-passive, you're involved. And I think it would be prudent as a lender that we would want them to guarantee as well. If you're passive, well, maybe that's the investor role, right? So most likely they're not going to want to guarantee anything. So we can ask, but most likely they will probably deny that. And that will be a discussion for how you want to go forward with the client. Lastly, I would say, and to wrap up, I don't know if I have anything other than guarantors is probably why we're going to look at these for the cash flow purposes, but we want to understand how we're connected to who's running this company, because they're making the decisions from that. And that's where the risk exposure is, kind of to us, but also to the owners of what they're, if I'm managing the operation, I'm at the helm, or in this case of the professionals you talk about, their decisions, they're responsible for them, and they better have some type of malpractice insurance as well. So anything else I might have missed, Linda, or we could wrap it up?
I think you missed a thing, but I do realize that this owner risk is just one piece of risk in general, right? So we definitely could talk about other aspects of risk. This piece today was just, how about the owner's personal risk for what's going on in the business? Because we could talk about risk all day long, couldn't we, David? I think that's it.
That's it. Let's wrap up. So that's owner risk that we basically can sense associated with pass-through entities. We hope that you enjoy our little banter, our questions today. We think it's helpful for talking about things that are somewhat confusing when we're dealing with pass-through entities. If you have any questions, you want to get more detailed focus on it, reach out to Lenders Online Training. We're here to help you. Look at it to experts online at Lenders Online Training. We're here to help you to get into the better details and train your professionals and help them understand these risks, possible situations. Until next time, see you later, everybody.
Bye.